I do want to welcome in our next guest, though, take a broader look at the markets. Joining us now, Anthony Saccaro, president at Providence Financial and Insurance Services. Anthony, great to have you back on the show. We've got a nice green morning. This week has felt a little bit like a roller coaster ride. We're up, we're down, we're back up again. But you describe it more as a holding pattern. So take me through that and what you're keeping an eye on right now.
Well, consumers in the market are just trying to figure out where to go from here. There's been a lot of tossing around back and forth about different things. The general focus is on Iran, of course, that war, and that's where people are thinking about. But even with the war, initially it was thought that it was going to be, very short, and now there's questions about whether it's going to be a little longer. And then there's the Strait of Hormuz, and so where do we go? And the market's priced in the war at this point. Depending on the measure that you look at, 7-8% down from record highs. But where do investors go from here? Is it going to get worse? Is it going to get better? And then on top of that, is the war in Iran the primary focus, or do we shift back to inflation? Right? Last year was all about inflation. We didn't get it. Tariffs were supposed to cause inflation. Now energy prices are supposed to cause inflation. We came into the year with the expectation of lower GDP, and we're seeing that lower GDP. People aren't spending money like they should be, but with the war going on, that's completely unexpected. So we are kind of in a holding pattern because we don't know what's going to happen. Everyone hoped the war is short-lived, and if it is short-lived, then everything will be fine. I'm actually surprised that the market has not reacted worse than it has right now, and that's the main thing. But at this point, it is a holding pattern.
And let's talk about inflation. Take a closer look there. I've had mixed commentary, many contrarian views about how impactful the situation in Iran is actually going to be to the inflation number, how impactful it's going to be to the Fed's path moving forward. What is your outlook on inflation for the year and the Fed's path forward? Do you see underlying risks? Is there stuff we're not seeing below the surface here? Or is this not going to be a mover in terms of the inflation number?
No, I think that inflation could pop back up. If we look at last year, we started off the CPI at around 3%. CPI is currently around 2.4%. The PPI print just came out hot with a 0.7% bump. The PPI is really the leading indicator of where things are going to go. That's the producer price index, what it costs at the wholesale level. And if the wholesale level prices go up, that's going to get passed on to the CPI, which means that our CPI next print might be much hotter than we're expecting as well. And all of that boils back to energy. The energy prices, a couple months ago, $60-$65 a barrel. Now we're in the 88, I think is what it will pop back down to or drop back down to this morning. But the energy affects the cost of everything. It affects industrials. It affects transportation. Getting something to your home requires oil. And so it's the backbone of everything. And yes, the Federal Reserve at this point is basically saying we don't know what to do either. Inflation, the PPI number is not so hot to where they're going to make some drastic moves, but it's certainly not come down enough and not showing us that it's going to come down enough that they're going to make drastic moves to the downside. So right now, the market is pricing in, I think, one rate cut earlier this year. I wouldn't be surprised if there's 0 rate cuts at all, even though at the beginning of the year, it was pricing in 2 to 3. So inflation is a holding pattern as well, too. We just don't know, but there is the risk that it could go the other way.
You're so right. There's so much wait and see right now. And I was just, as you were saying that, refreshing the Fed Watch tool because it's sort of an ever-changing day for us. But as I'm looking, there's no chance of a cut priced in all the way out through December. It's zeroed out now across the board, completely different than if we'd had this conversation a month ago. However, once we get into the fall, where we could potentially have a new Fed chair if we can get one confirmed, some questions about whether or not that's going to happen right now and what the timeline on that is. The chances of a hike go up to about 20% once we hit the fall. Do you think there is a possibility that we see that? And what would have to happen for that?
Well, there is a possibility. The possibility for a hike and the possibility for a cut are both possibilities. What would have to happen is the war would have to be prolonged and energy prices would have to stay high for a long period of time. That then would pass on to the consumers in the form of inflation. And at that point, if inflation starts to creep up again, the Federal Reserve is going to have no choice but to raise interest rates to try to cool that inflation. So that's the situation that we're in right now. Now, what's the other side? If the war ends soon, and I tend to lean on that side. I think it will end sooner than later. But then Iran came out this morning and said, no, we're not going to take the deal, right? So we don't know. But if the war ends sooner than later, one way or the other, the reality is that I think that inflation could go back down. Energy price is going to go back down. The Strait of Hormuz is opened up, or the U.S. oil reserves are opened up, and price drops back down to $60, $70 a barrel. That could be disinflationary as well, too. So it could absolutely go either way, just depending on the war.
So, Anthony, if inflation stays contained right now, but the risks linger, it's going to take us a few months to see if we get any impact and how much impact we get when we get the data. What kind of what environment does that create for investors over the next few months? And how should you approach that environment, this wait and see, uncertain environment?
Well, the market is forward looking. So if we know that the war ends today, first of all, I'm not sure that there's been enough inflationary pressures, even the PPI, to where it would have a dramatic impact. If the war ended today, inflation may be a non-issue. But if the war goes on for a few more months and inflation creeps up and it does become an issue, and we start to see it in groceries and we start to see it in other things that are absolutely affecting consumers, and then all of a sudden the war ends, yes, it's going to take a couple of months for that to back down, but the market is forward looking. If the market knows that this is where it's going, that the inflation is going to come down, the market will price that in ahead of time. So I don't think it would be anything other than positive for the market if the war ends all the way around. Energy come down would be very positive. Inflation would come down very positive. The Federal Reserve could then get back on a rate cut conversation, whether they do it or not. Very positive. So the war ending is very positive for the market. And I think you see it pop the day that the market believes that the war is over.
Well, we're seeing a nice pop today. Thanks for being with us, Anthony, to take a closer look at some of the potential outlook here and what we might see here, taking a deeper dive here into inflation. Anthony Saccaro, president at Providence Financial.